Well, hello everyone. This is Jason Lutz. We're with Rate Mastery. Thank you for jumping on our webcast today. I appreciate it. I have with me Bryan McNee, Senior Bond Analyst. But for those of you, and by the way, Bryan, can you see my screen okay? Everything look okay for everyone?
Looks great. Hello, everybody.
Good. I will be handing this over actually to Bryan here in a minute, which is exactly why everyone came here. They didn't come to listen to me jibber jabber, Bryan, but want to sort of set the stage a little bit for Rate Mastery because we have a lot of people on today's webinar, and I know many of you are new to Rate Mastery and what it is that we do here. So I want to set that up super quick and then hand it over to Bryan because we have definitely 60 minutes of jam-packed information that frankly makes this the most important webinar you'll attend about the mortgage market all year. But what we do at Rate Mastery is provide truly professional loan officers with the information that they need to be elevated as an expert, right? The information that loan officers need to have quality conversations with realtors and consumers about the one thing that realtors and consumers are really looking for you to help them with, which is what's the mortgage industry doing? What are interest rates doing? What are the things that are going to affect interest rates in the future, right? And that's the kind of information that they expect from you. And that's the kind of information and what we provide at Rate Mastery. And today is one of the best webinars that we provide all year because we set the stage for what it is that's going to be happening over the next year, along with kind of recapping what happened last year and the trends, again, to expect for this year. Okay? So Bryan is going to tell us all about that. And actually, before one other thing, Bryan, I wanted to mention
Sure.
for everyone on this webinar, while we're doing this transition from me handing over the presentation to Bryan to sort of drive, I want you to go to facebook.com/rate mastery because we are going to be posting this recording to Facebook, right? So you can rewatch it. You could be forwarding it to your clients and your partners. You can be sharing it with other loan officers that also want this kind of information to be able to share with their real estate agents and partners, right? Because they are interested about what's going on in the mortgage industry, about geopolitical events, about all kinds of stuff that will be affecting interest rates over the next year. And so make sure you go to facebook.com/rate mastery. Plus, we push all kinds of information every day that help you have better conversations with real estate agents and consumers. And it will just come across your timeline and you can digest it and again, share it with those clients and partners. So make sure you do that right away. And while I am changing the presentation over to Bryan's control, please go do that. Yes, you like the page, by the way. Someone asked, do you like the page? Yes, like the page. And every time we post something, which we do, once or twice a day, you're going to receive that across your timeline and you can see it. And again, you can share it with your clients and partners for that kind of information that makes sense to do so. All right. So, Bryan, it is all you.
Excellent. And now we know why my teenage daughter does not use Facebook anymore. Because a bunch of old fuddy-duddies like us are posting stuff on it, using it for business, for goodness sake.
That's
She
funny.
just got her first car, and I took a video of it was a surprise of her being surprised and finding it. And a couple days go by, and I asked her what she thought of the video, and she goes, "What video?" And I said, "I put it on your Facebook page." She goes, "Oh, "We don't use that." So I never saw it. So hopefully you can see my page. I've got 2015 Outlook, the good, the bad, and the ugly. Can everybody see that pretty well? I just want to
Absolutely.
make sure I'm showing
I
the right
can.
monitors. I got like 9 monitors in my office. That's one you see, Jason?
Yep, I sure do. Yep, and I
Excellent.
think everyone else
Okay,
does. Yep.
what we're going to do is we do this every year. And the goal here is to, take a lighthearted approach to everything, give you some tools to maybe model your business around as far as whether you should be purchase weighted or refinance weighted. And these slides, all you will need to do, for those of you that are subscribers and not the freemium ones, you'll be able to download these very exact same slides and just put your face on it. put your name on it, put your title on it. Near the end of the presentation, we're going to go over our spreadsheet. Same thing. Put your name on it, tweak it a little bit, make it a marketing piece. One of the best things you can do for your business is to get in front of realtors or any other type of referral partner and make the 2015 pitch to them. If they think you're an expert, they're going to send you business. You could even do it as a webinar. You don't even have to walk into their office. But get this material out, because this is the stuff that sets you apart. And what sets us apart is A, we keep it simple, B, we keep it informative, and C, we give you this without charging you some bizarre, weird upcharge to get access to the slides and stuff. So this is all yours. Now, let's dive into it. For those of you, particularly the MDS Authority subscribers, you got the 2014 year in review. What we did is we sent it out. It was customized with your photo, your company information. It was an email that you could just easily cut and paste and send it out to everybody. It told you everything that happened in 2014, what specific things made your pricing better or worse. So that has already been sent out to you. One of the charts included in that is we'll just spend a few seconds on right here, and that is basically at the beginning of the year, we had the worst rates of the year, the highest rates of the year. At that point in time, the Fannie Mae 3.5% was trading, right around 90, a little 99.6. And at that point in time, the Freddie Mac 30-year fixed was about 4.53% with 0.8 in origination and points. And then when we closed on December 31st, that had dropped to 3.87% with only about half a point in fees and points for December 31st, 2014. You can see that while we had some ups and downs, we had the GDP growth, we had the Ebola, we had Ukraine, Russia, we had all kinds of events going on, the quantitative easing stopping. Through it all, even though we had undulations for pretty sharp movements up or down, over the course of a year, here's a pretty straight line towards better pricing. And most of that didn't have anything to do with what's going on in the United States, nor did it have too much to do with the Federal Reserve either. So let's kind of address what are some things that we can just wrap our heads around and talk about to our clients. And let's not get too technical about everything. Let's take a look at some things that they can identify with. Everybody can identify with oil production and prices. It's all over the news all the time, and they're looking at the pump, and it's part of what they're doing. The labor market is very important. The housing market is why we're here. Mortgage demand, Federal Reserve. We'll talk about all of those today. And global issues that could shape our economy. The Grexit. The ECB QE, which we'll find out about tomorrow, maybe. Germany, China, currency wars, military escalation. We got all kinds of fun stuff to go through. First, let's put this all in perspective. Who will win the Super Bowl? Okay, and actually there is a reason for this. And when you text, you can, by the way, type in your questions and comments via the system here, and Jason will get it. But tell him who you think will go to win, and we'll have sort of an impromptu poll. But this really, when you think about it, does have a correlation with what we're doing. We're making projections for the rest of the year here for 2015, just like everybody's making projections about the Super Bowl. Now, what we know about the Super Bowl, and that's sort of by projections, we can state obvious things. Here's an obvious thing for you guys, and I'm 100% sure of this, and that is the Detroit Lions will not win the Super Bowl. In fact, they may not ever win a Super Bowl. So those are some of the statements that you can make that are just completely obvious. On paper, between the two teams, there is no question that the New England Patriots are the better team. But that doesn't necessarily mean that they're going to win. We saw Seattle face a better team. We saw Russell throw interception after interception after interception, and yet they still rallied to beat the Packers. So we have in the Seahawks a team with tremendous heart that'll never give up, and anything can happen. And then we have the thoroughbred, which are the New England Patriots and one of the best coaches in history and quarterbacks in history as well. You have an extremely well-run team and versus a team full of heart. The skill goes to the New England Patriots. The heart goes to Seattle. So who will win? But that also plays into what we're talking about here. You can look at the numbers and say, look, these things add up to a certain outcome, yet it doesn't happen. Just like the Super Bowl. It could very well mean that on paper the New England looks like they're going to win it, but regardless of what the stats are, Seattle could end up winning it. So important to keep that in mind. I'm also curious to see how many people are rooting for one team or the other. I think it's going to be one of the better Super Bowls we'll see. I love that Seattle won it last year, but it wasn't a fantastic Super Bowl. Okay, black gold. We're talking about oil. Practice? We're talking about practice? Black gold, oil. We're talking about oil. Why are we talking about oil when we're talking about mortgage rates? When have you discussed oil about mortgage rates? You didn't do it in the 90s. You didn't do it in the 2000s. Why are we talking about it 2015? Because it's a big deal. And we'll break it down for you. First of all, just pop this chart up 3 months ago because it's a 3-month chart. Hey, prices were at 79.38. They were actually a little higher before that, but 79.38 3 months ago, and yesterday 46.75. What's going on? It dropped 32 bucks in 3 months, and it's all everybody's talking about. Oil, 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 nonstop. Well, let's discuss why it's important and how it could possibly play a factor in next year. First of all, why oil matters in 2015? Well, there's 2 components to it. First, if you see 2004, the average family spent about $1,598, $1,588 on their gas pump, and this is just gasoline and motor oil because actually oil goes into everything. Cosmetics. I don't wear a lot of cosmetics, but I've been told I should. Plastics. You know, this mouse I'm using is made out of oil. So, you know, there's so many more things than this. But just at the pump, we're looking at a forecast of saving about $550. Whoops, how do I go back? How do I make that happen? There we go. $550 per family, household, in savings in 2015 at the gas pump. Is that enough? Is that enough? Is $550 enough? Remember when everybody got the $500 check? Remember that the part of the big bailout was everybody got a check? You know, how much impact did that have on the economy? It had an impact. There's no question about it. But the idea that $550 less in gasoline compared to 2014, is that enough to really move things along? And that's something we need to consider. What it does have a huge impact on is employment. A lot, you know, we've talked about how the non-farm payrolls have been, above 200,000 on average the whole year of 2014, and there has been times where a good chunk of that has been due to what's going on with oil and gas extraction, shale extraction, boom towns, heavy equipment manufacturers, yada, yada, yada. It's been a big component, and it's been a big driver. In fact, if there hadn't been some of those gains those months in the oil industry, we would have had a pretty weak non-farm payroll number. So this is why it matters. Now, initially, you need to understand that oil lowers the cost at the pump and in many, many raw materials, and therefore it's anti-inflationary. Remember, bonds hate inflation, and folks, we're talking about bonds here. Bonds move your rates. Rates are based on bonds. So bonds hate inflation. Let's do that 101. If you got a bond that's 5% and inflation's 1%, your real rate of return is 4%. You got a bond that's 5% and inflation's 4%, your real rate of return is 1. That's why we don't like inflation. So, but eventually, the cheaper input costs, which equates to higher consumer sentiment, leads to more spending, theoretically at least, and that's a big driving engine for economic growth. And growth eventually leads to inflation, which is negative for bonds and rates. So the question is really, at what point in 2015 will we shift from the first scenario, where it's anti-inflationary, to the second scenario where it is inflationary? Because at some point in time, that will occur in 2015. And so oil is important to watch. In fact, today's morning coffee update video, for those that watch it, keep in mind, I put a lot more in the video than I ever do in the written form of that. Because if you don't have 5 minutes for me to watch that video. I don't have 5 minutes for you to give you some information. So you watch that video. We said, hey, look, we're going to trade in this channel today, and it looks like oil might come off our bottoms and could pressure mortgage-backed securities a little bit. That's exactly what's happening today. So oil is something that we will continue to watch that we didn't have to watch last year. Now, what can cause oil prices to drop further? Well, a slowdown in China, which means less demand for energy. OPEC keeps its production volumes higher. Keep in mind, a lot of non-members, non-OPEC members are doing anything and everything to get oil on the ground. They don't care that the oil prices are below 50 or even, whatever the number is. They don't care. It's just cash that they need. And if the U.S. economy slow down, that would be something also that causes oil to drop. But the flip side of that is what can cause oil to rally. And I'm not T. Boone Pickens, and we're going to tell you exactly where oil is going to be in 6 months or what have you. I can just tell you what are some things that can make it move one way or the other. And I don't think that we'll see $100 oil next year. I don't think that it'll remain where it is either, but due to supply and demand features which exist now that didn't exist a couple years ago, and due to the efficiencies of the market, I just don't see a huge run-up in pricing. But the continued trend, keep in mind, over the last couple months, we have been shutting down drills in the U.S. Huge drilling operations shut down, shale extraction shut down. That means capital's not being put into machinery. That means these people are starting to get laid off. And we're going to get down to one of the lowest levels that we've seen in decades, where we'll have only 1,000 oil drills operating in the U.S. by April. So that cuts down dramatically on the supply, which eventually will lead to a pickup in pricing, and then these places will come back online. The problem is it takes a tremendous amount of capital and effort to get these things back online. You have to plan for months and months and months in advance before you get something going. Any type of reduction of production levels out of OPEC. Right now they're saying they're standing pat on the current levels, even though you have some member countries saying that they might be willing to play a little bit with the numbers. But the bottom line is this was a brilliant stroke by the Obama administration, for sure. It accomplished so many things that they wanted to do. Because Saudi Arabia didn't do it on their own, folks. They had a lot of help and support from us. It crippled Russia because it just drove their ruble to the ground. It lowered costs for just about everything for consumers in the United States, which is great. And the extra added bonus is that it crippled the shale industry, which the Obama administration is not a fan of. They feel it's an environmental holocaust, and they want it gone. So it is a brilliant stroke by them. It did accomplish a lot of things. If we get a rebound in the Eurozone, which I don't think we're going to get a rebound in the Eurozone, but BRICS are what we need to watch. They are Brazil, Russia, India, and China. Those start to get a rebound, and it's possible to get a rebound in at least two of those. Then you could see oil rally because the demand will pick up. So black gold, something that we need to pay attention to in 2015 that we didn't pay attention to before. Keep in mind, oil is probably at or near some sort of low for the year, and that could also mean that your interest rates are at sort of a low for a year. Okay. Now, the labor market. Labor is the key to housing. All right, and of course this is being recorded, and when you replay it, one of the reasons I want you to replay it is to kind of get some talking points to make this your own and present it as your own. So many times the labor market is many more times more significant to the housing market than interest rates. We have seen low unemployment rates and significantly higher interest rates than we are now, and had a fantastic housing market. Okay, so you don't have to have low rates to have a strong housing market at all. The unemployment rate throughout 2015, and we'll show you on our spreadsheet in just a few slides where we think that'll be, it will continue to drop to levels that are historically very strong for housing. But a large component of that drop is due to the participation rate. And for those of you that understand the participation rate, the unemployment rate is not factual. It's not based on paychecks. You know, this world of computers where we know everything is tied to everything, This has nothing to do with it. It's just a survey. It's the same methodology they've been using for decades. Um, Basically, if they call me up and ask me to take the survey as part of their sample size, and they ask me if I have a job, and I say no, then they ask me, well, am I looking for a job? And I say no. I'm not unemployed, even though I don't have a job. That's called the participation rate. If they ask me if I have a job and I say no, and they ask me if I am looking and I say yes, then I'm unemployed. So that's the difference there, the differentiation there. The participation rate is at or near an all-time low, meaning there are hundreds of millions of people who are not counted in the unemployment rate. So, but the unemployment rate will continue to drop regardless. Now, the key for all of this are the average hourly wages. Now, we've been talking every time that non-farm payroll numbers come out, because we poo-poo the unemployment rate as a whole. The bond market doesn't care about the unemployment rate. It's the non-farm payrolls that we look at. And then we get into the average hourly wages. We want to see true wage inflation. We'll talk about the Fed, I think, in a slide or two. But the Fed is also looking at this due to labor slack. Labor slack, even though we've seen a pickup in non-farm payrolls and we've seen a decrease in unemployment rate, we haven't seen any hourly wage inflation. And that's the type of inflation that's real. That, that tells you that you have a functioning marketplace. We see JOLTS reports where we know that the job openings are increasing, and we see the Challenger gray cuts are decreasing, but we're not seeing, and we see more people going back to work, but we're not seeing the mix that would impact hourly wages. Now, that's the key. Mortgage rates will not make, and this is something you can write down right now, mortgage rates will not make a serious run higher until we start to see average hourly wages get squeezed. And that isn't going to happen in the next report, okay? So that's something to be very careful. Now, it has to come from a real dynamic. It can't come from government price controls. What do I mean by that? Okay, let's say you make $7.50 an hour, and your state passes a law that says minimum wage is 16 bucks an hour. That's not an increase in hourly wages due to scientific economic forces. Okay, that doesn't, an increase in the hourly wages, we're looking at that as a telltale sign that the market is working efficiently and that there are fewer talented workers available for the jobs. In other words, the companies have to attract workers with more money to come over to their job instead of the other job. That wage inflation is very key to our economy and to our interest rates. But if you just simply change the bar because of the price controls, that's not true wage inflation. Even though it may show up in those numbers, economists will discount it. So that's something we have to be leery of, is that all of these new laws that have come into place doesn't necessarily mean that the market is operating efficiently in the correct way. It just means the government fudged it up. Okay, so hourly wages, number one key when it comes to labor market in 2015. The Federal Reserve, I was right, we did have a slide coming up. Janet Yellen and crew. Okay, we have a few new voting members in 2015. QE is done and rates have fallen even further due to global issues. This is setting the stage that if the Fed wanted to adjust their Fed fund rate, it's not going to have any type of real material impact on the economy this year. And we'll go over how we think that'll play out for the year. But the original triggers of 6.5% for unemployment and 2% for inflation, they've been thrown out the window. Okay, the unemployment rate is at 5.6%, and it'll probably drop a tiny bit. They're watching labor slack and average hourly earnings, not so much the actual rate. They've said that they understand that due to longer-term oil prices being so low, that their 2% inflation rate can go down all the way to 1.4%. The market has glossed over this. The Fed has said they would be willing to start adjusting rates even if inflation year over year is around that 1.4%, if they feel in their projections that it's sort of a waypoint on the way up to 2%, not 1.4 on the way to 1.2 on the way to 1.0. So they have left the door open to get away from the 2% trigger. And so we need to understand that. According to Fed speak, the Federal Reserve and their timing of when they said that the minimum amount of time between moves, we could see a rate hike at the earliest in April, but no one really sees it that way. Bond traders peg it pretty much at mid-year, and stock traders think it's the end of 2015, if at all. So it just goes to show that bond traders and stock traders have just simply different viewpoints sometimes of what's going on, and who's to say which one is right, which one is wrong. I can tell you that at the end of this year, 2014, we had two things happen. We had an all-time high in the stock market, and we had an all-time high in the MBS market. Those are supposed to be opposites. They're not. They both hit all-time highs. So it just goes to show you that they both have different ideas of what's going to happen. Now, regardless, a higher Fed fund rate will be a reflection of a functioning U.S. economy, and that is a good thing for housing, even if it tweaks your interest rates a little bit. And the goal here is what's good for housing, and it's not a low interest rate. Okay, 1 to 4 family originations by quarter. This is historical, and then the last little tail end to the right here, these are the projections based on the Mortgage Bankers Association of America. Now, there's a couple things. I want to spend a second on this slide, and of course this slide is you know, you'll have it too. I don't know how long you have been in the business. I've been all the way through here in the 90s. Jason, I don't think you were even alive in the 90s. I don't know how long you've been in the business. Where have you been? When you are in these blue sections, see right here, I don't know if you can see my mouse moving on your screen or not, but on this blue section up here all the way through 2010 to basically the end of 2014, this is a refinance market where more of the business has been in refinance than in purchases. And what we can tell is if you take your eyes and move leftward and you see these peaks that are in red, that's when the purchase business has run. And you see that if you were in the business in 94, you were in purchases or you didn't survive. And I'm concerned that a great deal, particularly with the compensation methodology for taking care of originators compared to the way it used to be, disincentivize, if that's a word, originators to go out and get the purchase business and form the relationships that they used to, because they used to get a larger cut of every loan. So here what we have is you have to be very careful in that you'll see that the red, meaning the purchase business, is diverging upward from the refinance business. And that, if you're just doing refi deals, I mean, I know you probably have clients that you refinanced 2, 3, even 4 times over the last 5 years. That's gone for 2015. Right now you have historically low rates. You might get some in January and February, but for the year, this is not a place to be in. The refinance business is not the place to be in for this year. Okay? Now, what about housing? Okay? We see a small but steady improvement over 2014. Why? Well, some of it has to do with the loans. We're going to have lower down payment requirements. We already know that with Fannie and Freddie. We also know that we've got a little loosening of underwriting standards as far as debt to income and credit. Not much, but a little loosening helps, particularly when those were shut out before. We most likely, because President Obama wants it, see some change in FHA as well with their insurance rate, their private mortgage insurance rate, which will make it more affordable. So you've got some things on the lending side which will help. You have U.S. economic growth, and I don't care who you are, if you're down on the economy or high on the economy, the U.S. economy is growing. It's not a recession. Each quarter it has grown in some measure more than the prior quarter, so it's growing. We have higher employment levels. Again, throw out the unemployment rate and you look at the number of non-farm payrolls added each and every month, it is higher employment. And we'll see that trend continue in 2015. And in 2015, we'll see slightly higher mortgage rates. Those are all things that are good for housing. You might say, well, no, 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 no. We have to have historically low interest rates in order for purchases to do well. Well, you've had that, and it hasn't done well. It's just treaded along because the labor isn't there. You know, the income isn't there. The jobs, the stability, the good credit, because you have a stable job for a while, that just hasn't been there. So it doesn't matter what the rate is. It's employment. Now, existing home sales were 4.937 million in 2014. That'll rise just slightly to 5.3 million in 2015. That's great. Now, here's the key. Don't get caught up in this. We're not in a housing bubble. The median single-family price is going to decrease just ever so slightly from 207.5 thousand on average in 2014 to just below 207,000 in 2015. That's not a horrible reversal. That basically means it's moved sideways. Why is that? It has to do with the product mix is going to change in 2015. You're going to have a lot more first-time home buyers getting into the world at a different price point. It's just a different product mix. New home sales, you know what? It's going to continue to struggle between 500,000 and 600,000 units in sales. But the new home sales price will continue their upward trend. So the new home sale prices will outpace the existing home sales prices. And why is that? That's just because the home builders, which had gotten decimated, are very efficient in identifying. They're no longer making the giant cookie cutter subdivisions and, you know, build it and they will come type deal. They're building to a specific niche market that has a certain margin in mind, and they've gotten the land for cheap. They've got it all worked out. It's a very efficient construction cycle this time around. New home starts about a pace of 1 million to 1.3 million per year, and you know that's about where we were for the second half of 2014. So housing is pretty good. We're not going to see a blockbuster year, and we're not going to see a real step backward either. So that's okay. Now, let's talk about some of the things that have nothing to do with what you and I do that have had tremendous impact on our interest rates, more impact than the Federal Reserve has. One of those is Greece. We've been talking about Greece for years. The bailout upon bailout upon bailout. The Grexit, which is kind of cute. The Greek exit from the Eurozone. Now, they are very dysfunctional over there, and they're not happy that the European Union, the European Central Bank, and the IMF, and everybody else that's got together to bail them out, has imposed these horrific restrictions on them. My goodness, they have to have a balanced budget. They can't spend more money than they take in taxes, and they have to pay off their debt, which has been I don't know, it's not really refinanced because so many people had to take a haircut on it, but at any rate, the citizens are not happy with how they have to live and operate under this oppressive guidelines that they agreed to. And they've had 3 attempts to elect a president and out of their group, and they haven't been able to do it. So they're going to have a populist election on January 25th. Now, most polls and analysts say that the radical left party will win. Now, the question is whether or not they win by enough because of how they do things. If they win by enough, then they can appoint their own president and control the government. If they win, but by smaller margins, then they have to share some of their control with one of the other parties. The primary front runner out there, he's threatened to renege on their bailout agreement, which effectively is saying he's going to, and he's backed off a little bit, but the concept is that he's not going to accept the status quo, which is why people are voting for him. That either they'll renegotiate everything to better terms, or they'll just simply get out of the Eurozone. And this is a huge concern amongst bond traders right now, and it is actually a very large portion of why your interest rates are as low as they are right now, even after the Fed has stopped purchasing mortgage-backed securities and treasuries. And because it's not just about the Grexit. There are big movements in some of the other countries, Spain, Italy, what have you, that are also very unhappy with the Eurozone. And this could cause a lot of momentum. That's why, boy, everybody stopped everything to save Greece, because it was this domino effect they were concerned about, particularly with all these bonds that weren't being paid. So this January 25th, the Grexit will be very key, which takes us right to the European Central Bank. what's happening tomorrow? Okay, now this is a 2015 outlook, but a lot of it has to do with tomorrow. But we've been here before. We've been here before where Draghi's supposed to announce the new QE measures, and then Thursday comes and he alludes to the fact that they're getting ready. He's given his staff instructions, but there's never been any QE really. So now the market feels that he really will do QE for two reasons. One, an important legal hurdle was passed in German courts. It's not over yet, but also Germany just completely opposes this type of situation. Their whole thing is that they're concerned that this money from the central banks will be pulled together and then buy bonds of countries that have no way of paying it back, and then it'll default. So what Draghi's counter-proposal has been this last week to German Chancellor Merkel is that the central bank in each individual country will buy its own debt, kind of like what we've done, a snake eating its own tail. So that way it's compartmentalized, and in that way Germany's taxpayers don't have any risk to, say, people in Spain that are buying the Spanish bonds. This appears to have some traction, and we've even had a leak this morning from not Draghi himself, but of a proposal that would be 50 billion euros a month. And so we'll have to see how this actually plays out. One thing we know is that so far the bond market this morning has had no reaction to this quote-unquote leak, because that's what the market's expecting. So the devil is in the details, and we'll have to see exactly what happens tomorrow. Will it even be enough to get the European Union going? One thing to be sure is that it's probably not going to be something that will give you long-term better interest rates, because we have deflation over there. We know that they're not going to be efficient at purchasing. They have lots of legal challenges still. This will have to be watched. This is something that's a real wild card when it comes to pricing that we'll have to deal with. Military conflict. There's stuff going on all over the place. And whether it's ISIS or Ukraine, Russia, which is back in the news this morning, or the protesters in Hong Kong, which have been finally shut down by China, or what have you, any type of military conflict can and may show up sometime in 2015. 2015? How about 2015? And that could cause a temporary spike in demand for our safety of bonds, as we have seen so many times over the past year. So I don't expect peace to overcome everything next year, and those will be things that we'll have to be watching out for. Now, China. Man, we just got their GDP for 2014 came in at 7.4%. Man, that's the weakest year-over-year growth since 1990. Are you kidding me? That sounds like such a huge number, 7.4%. But, you know, keep in mind, they're coming out of Stone Ages. But industrial output shot up 7.9% year over year, and retail sales jumps. Which could that lead to a soft landing for China? There's one thing that China has going for it, even though it probably will have slightly lower GDP growth in 2015. At least that's what the BlackRocks and the Goldman Sachs, those guys are projecting. Even though they have a little lower growth rates, you have to put it in perspective. You can't compare a 6.8% rate in 2015 versus 1998 or even 2000. Their infrastructure is different, their population is different, everything is different. So we have to see how that is, because as China grows, their demand for energy, raw materials, yada, 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 is something that could directly impact pricing. So bottom line here is the better China does, the worse it is for your pricing. The worse China does, the better it is for your pricing. It's really that simple. I got a couple pictures here of ghost towns. Oh, I got to do that again. How do I go back slides? There we go. All right. Are you guys familiar with some of the ghost cities? I don't mean like a subdivision that's like in Detroit that's closed down. I mean, they have built entire duplicate cities of the United States. They've built an entire duplicate of Washington, D.C. They've built high-rise towers. You know, that's all these bank loans are going bad because they've built these things and people aren't in them paying money. This is a real concern. They have cities, bigger cities than what I live in, that are completely empty, that are brand new. So this is something that's quite curious to me. Now, they are going to move. They're in the #1 position as of a month ago in buying our debt. Okay, they're going to drop to #2 because Japan, as far as their Abenomics, have been buying our treasuries left and right. And Japan was a big holder to begin with. So Japan is actually going to be the largest holder of our debt, and China will drop to #2. They have massive amounts of golds, which they have been purchasing. And this is key because we're going to start to see more and more where after we forced them to split off from the U.S. dollar, pegging to the dollar, which I understand the financial reason for it, but in reality it gave up control of a dollar-dominated world as soon as we did that. And now that China's on good footing, the yuan is poised for dominance against the dollar. It's taking incremental steps. We're seeing contracts written in yuan instead of dollars. We're seeing big deals being done between China and Russia and Iran with oil. China's buying the heck out of lower oil prices, even though their production levels are a little slower because they're stockpiling it. They're buying contracts for it because they're buying it at the cheap end because they've got the cash to do it, and they're poised for some growth there, some soft landing and some growth. So they're going to be key to watch. They're a really big gorilla, and they actually act more capitalistic than we do, and so that'll be very interesting to watch going forward. This is well, he'll edit and splice this together in Camtasia, so and I can show him how to do that. So when you replay this, you won't have this huge gap. So let's go ahead and get to where we were, which was on rates. Wasn't it like a cliffhanger? So I got right to the rates charts, and then I disappeared. So okay, here we go. Mortgage rates 2015. Now we showed you this chart on the left here, where we had the highest interest rate, the lowest price for mortgage-backed security, right in the very first couple days, first month of 2014. And then we had a pretty steady, gradual move upward to the highest prices of 2014, which gave us our lowest rates of the year, including a huge swing on October 15th. But all I did, and nothing really fancy here, I figured out how to use a computer, and I flipped this image. And so this is pretty much what we're thinking for 2015, in that we're going to see like a bell curve, our best interest rates for the entire year right in the next month or two, and then after that we'll start to see a steady and gradual decline in MBS prices with lots of volatility, of course, but by the end of the year you'll have higher rates than you did at the beginning. So just sort of a reversal of what happened in 2014. And let's go over a little bit how we look at that. Now here, in a second, I'm going to go from this PowerPoint presentation and go right into the Excel spreadsheet, which I think I can do right now. Hopefully everybody sees that. Now, the Excel spreadsheet is for you. You can type in your name right here, contact information, get it completely customized. If you don't like some of the projections in here, go ahead and change them and make them your own. Put your own thought into this. If you've read a report from a certain analyst that you just really think is dead on, then change some of these numbers. It's not copy protected, write protected, anything. Just customize it, print the heck out of it, hand it to every realtor out there, hand it to your clients. Do what you need to do, that your name, even put your face and logo on it, which is what I would do. You're the guy. Let them stick this on their wall, right? Let them stick it on the wall and have projections, because when they talk to a customer, the realtor wants to tell them, well, yeah, you know what? This is a great price on the house. We think that interest rates, my interest rate guy, my loan officer is telling me that gradually over the year they'll slightly tick up. So maybe you should take advantage of where we are right now in this point in time. This is a tool you're giving to realtors that nobody else is giving them. Take advantage of it. So that being said, the U.S. economy, GDP, of course, we had that ridiculous 5% reading in the third quarter. The question is, through the rest of the year, what do we see? Well, in 2014, we don't have the final fourth quarter number yet, but we had that first quarter that was negative due to the Arctic, whatever you want to call it, vortex. By the way, the wall that we kind of have built between Mexico and the United States, that wall needs to be between the United States and Canada to keep the cold air out. That's where that wall needs to be. But the GDP, man, we're looking at going from 2.5% in 2014 to something with the 3 handle. Now, that's very key because mortgage-backed securities historically don't really react very well in an environment above 2.5% consistently because it's inflationary. So while oil prices might remain low, the growth rate would be such that it would sort of offset that and cause mortgage-backed securities to pull off. So that is key. Unemployment rate, we see it getting down, 5.5%, maybe picking back up a little bit in the middle of the year due to all of those people not working in the oil industry, etc. But it's covering 5.5%. The average for 2014 was 6.2. So those will be key to watch. Non-farm payrolls average per month. Keep in mind there's 3 months in a quarter. So hanging not too far off the 200 every single month is a very good rate. It's nice and mild. We're thinking we're going to average somewhere between 213,000 new non-farm payrolls month over month throughout 2015, which is very nice. It's not meteoric in nature that would cause damage to the economy from going too fast, but it's a nice level. In fact, it's a little lower than last year's, which averaged 227. In 2014, we averaged 227,000 non-farm payrolls a month, even with that horrible January in there. So that's something to keep in mind. Fed fund rate. Right now, it's between 0 and 0.25. We expect that to certainly hold for the first 3 months of the year, the second 3 months of the year, but then right there, right after the halfway point, we start to see it be gradually massaged. Now keep in mind this is a quarter, so you actually have a couple Fed meetings between here and here, and there's no real way of knowing, well, they'll raise it at a quarter at a time or a half at a time, but we see the Fed fund rate starting to tick up. Again, the bond market sees this, the stock market does not. So this is something to take into account. The average in 2014, 0 to 0.25. By the end of 2015, we think the Fed fund rate is 1. Now here's something, folks. I know all of you know this, but you know how to calculate prime? What is prime? Prime is nothing more than 3 points above the Fed fund rate. So if I know the Fed fund rate, I know what prime is. Prime right now is 3.25. That's going to go to 4. Whoop-de-doo. That's not a huge change. It's not a secular shift from one way or the other. 10-year Treasury note yield, why we're well below 2% right now. And just about everybody's projections, including mine last year, would be that we'd be closer to that 3 range at the end of the year. But again, it doesn't have anything to do with what's been happening in our local economy. It's everything else global. The currency situations, the ECB, the flight to quality in the U.S. bonds, anything and everything has kept those rates low. And it'll continue to keep them low, but we can't operate at below 2%. Below 2% means that the world is going to implode at some point in time, and it just won't. Gradually, that will start to tick up. 2.2 the first quarter, all the way, dare I say, to 2.8 maybe by the fourth quarter. It's not bad. You know, even though we're below 2 right now, you know the average for 2014 was actually 2.5%. So we're really not going too far out on a limb there. Fannie Mae benchmark 30-year fixed rate. We started off at 3.66 was the January 2nd or 3rd interest rate was the national average. We see that ticking up to a whopping 3.9. Ooh, hold on to your pants. 4.3 and all the way up, goodness gracious, to 5%. So when we had that mirror image, we told you it went from, let's see, it went all the way from 4.875 down to just below 4% throughout 2014. The average was 4.2. And we're saying by the time you close 2015, you're going to do just the opposite. It's not really a big movement. It's actually fine. That's a good level. Now, housing median pricing, pretty decent levels throughout. Again, we showed you on the housing slide that it would be just a tick below 2014 on average, but the median home pricing new by the end of the year, 285,000 versus 2014's 277,000. We showed you the existing home sales already. Housing starts on average a lot better than 2014. Mortgage originations. This is where you come in. You'll actually originate more. Okay, I'm sorry. Yeah, more. In 2014, the entire industry, $1,122 billion. It's going to go up to $1,189 billion. But refinances will go down and purchases will go up, right? So that's something to keep in mind of. Purchase business will go from $638 billion to $733 billion. Refinance business, $456 billion to $379 billion. What are you gonna do? You've got to start moving towards purchase business. That's the bottom line. Will there be refinance business to be had? Of course. Why? Because it won't just be about interest rate. There are some people right now that have a 6.5% interest rate. Oh my, they can't refinance. Why? Oh, a lot of reasons. Even with heart, they can't. But what we're going to see is as these home values, as these home sales complete, you're going to have better comps. You're going to have less people underwater. As the job picture picks up, you're going to have their income and their credit improve. And so you're going to have opportunities for refinance. But it cannot be the driving model of your business. It just can't. Because 2016 is going to be even more of a purchase cycle. So good luck. Good luck 3 years from now refinancing people that got a 30-year fixed interest rate between 3.6 and 3.9. You know, is that what your business model is? You're going to refinance them? Good luck. All right. So that's my spiel.
So
go ahead,
real quick, Bryan. Real quick on what you're seeing in your numbers, and I just want to clarify because a few people have made mention of it that refinances will go up. They're just not going to go up to the same degree in this, from 2014 as predicted as the purchase.
Refinances as a percentage of the pool of loans that turn into mortgage-backed securities will decline from 43% in 2014 down to 38% in 2015.
Is a Correct. Percentage. Gotcha. Okay.
And as far as total dollars,
not the actual number.
Right.
Yeah, it goes up slightly. Okay.
All right. Okay. Well, hopefully, if you got a couple people that have banked some questions, I'm happy to answer them. And the space heater is turned off, so it will not trip my thing.
One of the things that is not really actually specifically asked, but everyone's kind of been tiptoeing around it, which is the inflation-deflation sort of question. You've mentioned several times that inflation is interest rates go up and the opposite with deflation. But is there a scenario where we can see this prolonged deflation be no longer a benefit for the economy, or at least a perceived potential benefit, and things could really sort of start to unravel? I mean, you hear a bit of it, the deflationary spiral, right? How would that potentially affect interest rates in the mortgage industry?
It's a very good question. Okay, let's kind of break a couple things down, which is what I like to do with a teachable moment. First of all, deflation, just because bonds don't like inflation, it doesn't mean that they like deflation. Bonds don't like deflation either. Deflation is awful. It's evil. It means that they're not going to be able to pay your bond back. No, we don't want that at all. We want growth, but we want lower levels of growth so that you can pay back your debt and that you don't eat away at my real rate of return. So no, bonds do not like or even want or smell, taste, think about deflation. We do not have deflation in the United States. Okay, when you have GDP grow, and let's say you don't like these numbers of 3%, let's say you want to change them all to 2%. That that's growth. Okay, the deflation picture isn't in the United States. It is overseas, which is why they're not buying their bonds. They're buying our bonds because our bonds don't have deflation associated with it. So the deflation overseas is causing everybody to want our bonds for safety and to protect their financial interests. So that's why deflation is helping bonds right now, because of the fear of it. But in the United States, we don't have deflation. Just because oil prices go down, that's not deflation. Okay, the overall economy is growing. There's things that are going down and things that are going up. So growth in the U.S. is here. The labor market is growing. This is not deflationary. There's no thought of it here. So I guess that's how I want to segregate those two issues. Got it?
Okay.
Yeah, good.
Yep, for sure. Quite a few people actually have also, and Barry kind of hit it on the head here, which is that the idea that the reduction in oil and pricing, that is, per barrel, for any prolonged period of time could result in a lot of layoffs, or at least more layoffs than we're getting the benefit from, additional spending,
Yes.
right, or disposable income. It could result in more layoffs that could ultimately further push down the 30-year fixed and interest rates, down as low as 3%. Is that something that we should be
Yeah,
um,
that is
worried
the
about?
question. In that, um, at what point does the lower oil prices and the resulting layoffs in that industry and the capital that's not being expended there, um, at what point is that offset by more consumer spending because the average Joe has another $550 in their pocket that they didn't have to spend? That's what economists are looking at, okay? At what point does one offset the other? But at no point um, do I think that the oil business in the United States will get so bad that the unemployment rate will move from 5.6 to like 6% because of it. For every oil job that's lost, that's a good paying job. Talk about average hourly wage inflation. That's a good job that's lost. They're paying those guys bucks to do anything and everything, menial or otherwise. Those are big jobs to lose. They're getting replaced with other jobs that are being created through higher consumer spending. And that's what we have to look at. My sense is that at some point in time within the first quarter, beginning of second quarter, we start to see oil start bouncing between the 50, 60 level again. And I know other people are saying it could get all the way down to $25. So I don't really know. But the lower it stays, the longer it is. It's crippling Russia, which is causing them to behave in a way that's actually, how to put it, they're actually making some moves that will change the world monetary mechanisms permanently in a way that actually is not very good for us. So we're moving from throwing our weight around and damaging them to eventually that's coming back to start to damage us a little bit financially. And so there's that sweet spot there, and we have to be careful.
Right. And by the way, a couple of people have actually mentioned this at the same time, and Mike, you're one of them. That it's kind of odd that Christmas sales were down, even though price at the pump was
Yes.
down as well. So maybe kind of lending itself to the notion that maybe the fact that the disposable income isn't enough. And Brian, I get your opinion on this. You mentioned earlier that we had a scenario where the not too long ago where we had the stimulus package that most families received a $500 check in the mail, which didn't really do anything,
No.
really. I mean, when looking back on it, because people didn't believe, or not even believe, they knew this wasn't sustained. And is that sort of your thought process here? Is that the economists are thinking, how long will it take the average consumer to believe that they actually really have this additional, few $100s a month in disposable income because of the lower gas prices versus this a little blip in the screen and their world is
You
going to
know, that's
change,
I
just as
think
quickly as it did
January,
change,
know,
right?
I never want to come across as the know-it-all guys, right? I think that January will tell us that because what we had in December is retail sales were down, right? Um, but we got that January preliminary University of Michigan Consumer Sentiment Index, which was off the hook, yo. It was extremely robust. And so the question is, does that spike in the consumer psyche coupled with not just a couple weeks, but a couple months of lower gas prices, does that show up in January retail sales? And you know what? That's what's going to get me to believe one way or the other. I'm still on the fence. If we see a strong retail sales report in January, then I'm going to get off the fence one way. If we see a flat retail sales, then I'm off the fence the other way. So I really think that January is the bellwether for this.
Okay. Just as a reminder, again, quite a few people asking the question, which is, how do you get your hands on the slides, the Excel spreadsheet, all of that? I will be emailing all of our 1003 Magnet members, all of our LO Magnet members, and all of our MBS Authority members with a link to our video, which is basically our Facebook page, right? Facebook.com/rate mastery. And no, you don't technically need to be a member of Facebook to view a Facebook page. You're going to be able to see it. But if you are a member, again, like our page because you're going to see a lot of good stuff come through. And on that email, I will attach the brochures and all of that. And for those of you who are not, all you got to do is join 1003 Magnet if you're an individual member. It's a buck to try it out, and you will have all of this stuff along with just a ton of other things that we provide. And so I suggest if you're not a member, sign up for $1, 30 days, and then immediately call our customer support, and they'll walk you through so you can get a real clear idea if it is something you want to continue with. And you will have received the information, the slides, the Excel
So,
spreadsheet,
they
all
get to
that
get it
stuff.
online? I thought the
Um,
idea was that they had to come meet me at a local tavern and buy me a beverage, and I would hand them the forms.
oh, I mean, is there anybody that would do that? I mean, Brian, they may do just the opposite. Hey, let's see here. What other questions? A lot. It's actually coming through. Oh, the results. Super Bowl. Sorry, I actually wrote it down and was counting. So we had just under 100 or so people respond. And oddly enough, which is surprising to me, I think it might be more of indicative of where our members are located. We had
Woohoo!
59% Seattle, I know, and 41 New
Wow.
England. So yeah, kind of flip-flop from what it is that you were just. I think you were trying to skew the results earlier,
It's
saying that
my
New England
it's my
clearly has a better
State of the
team.
Union. I'm trying to skew everything by presenting some false facts. But yeah, it's on paper. It'll be a very. I can't wait. I don't know that I've been this excited to see a Super Bowl in a long time, and very excited about it. I think it'll be very key because it is two completely different types of teams. Both deserve to be there. I just can't wait to watch it.
Yep, it'll be fun. All right, very good. Thank you, everyone. It's been a little over an hour. Of course, we had about 10 minutes of super downtime. Thank you, everyone, for staying on. Just about everyone is still on as we speak. Again, we're going to be posting this online, so you'll be able to review it again, along with that, section that dropped out. We'll cut that out, and you'll be able to forward it to anyone as well on the video. So thank you, everyone.
Yes, thank you, everybody. Thanks for your time. Remember, use this. Make it your own. Change the slides. Change the projections. Make it something really cool and benefit from it. Have a fantastic day.